Well, good afternoon and welcome to another Mortgage Minute with Art Alvarez. My name is Jeff Harrison, and we're going to explore some things today that maybe you've heard in the news and what's going on. And of course, Art's favorite line, and I think we have to hold true to this. It seems to always pan out is beware of those headlines. Hey, I just want to welcome you again. It's a spectacular day here in the Coachella Valley, and quite frankly, most of Southern California. We do have a storm coming in, but right now it is fantastic. Tomorrow is Good Friday, and I want to wish you a happy Easter for everyone that's joined us live and also in recording. So let's get started because Art has just come back from the board of realtors to find out exactly what is going on there. Let's bring him in. Hey, Art, how you doing?
I'm good, Jeff. How are you?
I shouldn't have said that. A lot of my friends are realtors, and I was just teasing.
No, I understand.
So welcome back. Hey, you had a fun week last week. You were at doing the March Madness. Tell us a little bit about that.
Yeah, it's that trip involves. I've been doing it now for about 12 years. There's a group of guys. I'm associated with it because one of my high school friends is involved in this group. For 27 years straight, they've been going, well, initially to Las Vegas. More recent years, about 10, 12 years ago, they switched to Laughlin. I think because Laughlin's, more affordable. And so this group of guys, this year, like last year, we had nearly 50 of us go there on the opening week of March Madness. And we have a schedule all laid out. There's 3 different golf outings, a bowling tournament, and then the rest of the time we're, in the hotel in the sports book watching the, opening week of the March Madness and betting on the games. So it's just gotten to be a ritual that we do every year. And it's remarkable that we've done it this many years. And every year we also, in fact, I'm in charge of designing, or not designing, but getting T-shirts made, that's associated with our outing. It's a pretty fun event. So.
Well, I just finished listening to a podcast, and they were talking about how important it was psychologically to have community, and doing what you're talking about. To say you've been doing it for 27 years.
I haven't myself personally, but I got pulled into it about 12 years ago. But yeah, the group, including my high school friend, have been doing this every year for 27 years.
It's amazing. They're saying that in the study, they said the first 3 interactions, you're still kind of getting to know them. But by the time you get into the 4th group meeting like that you are going to probably look back and say, I have friends now that have been friends for life since that began, because you really have built up a friendship. And it's just, I think that's great. Congratulations.
Yeah, that's exactly right. Yeah, for sure.
Well, hey, I don't want to dribble the ball here. I do want to turn it over to you. A nice safe pass, little bounce pass there, trying to stay with the whole basketball idea. I just want to remind those folks that are joining us live, Art does take questions. In fact, he invites your questions. Please put them in the comments, no matter where you're listening, whether it's YouTube or Facebook. Please put them in there. I'll be in the background catching those and sending them over his way. And then also, if you're watching this afterwards and you have questions, please put them in the comment, and Art will always follow up on those. With that, Art, I'm going to turn it over to you. Let's have a great show.
All right. Thank you, Jeff. Hello, everyone. Welcome to this week's Mortgage Minute. Jeff is right. Spectacular day here in the Coachella Valley in the Palm Springs area. But, of course, we do have a storm coming. So I guess it's the calm before the storm. As you probably know, if you've been watching the show before, we like to start off by giving you a mortgage market and a bond market update. So let's get right into that. As we always do, we start with giving you a glimpse here of our rate grid on our website. Now, this is a grid that gives you what I call mortgage pricing indications, because these rates that you're seeing here are all based on certain parameters, but it gives you a general idea of where the market is. And when you look at this, I think what kind of comes to mind is stability. We've sort of entered into a pretty stable range in terms of mortgage rates. As you can see here, we're still looking at rates in the about mid 6s, as low as 6 3/8 on a conforming 30-year fixed. FHA VA still under 6. You can see at the top of the grid, the 2-1 buy downs and 3-2-1 buy downs start with note rates at 6.5. So you're looking at first year rates of 3.5 or 4.5, depending. So I think that's good news that we have a relatively stable market in terms of interest rates. Again, as I've said before, I think everyone should settle into this level. I think we're going to be at these levels for a while. We're hoping for some improvement later in this year, which we'll touch on a little bit in a moment. And these rates you can see supported by the 10-year bond chart. We always like to give you a 5-day chart of the 10-year bond yield. The 10-year bond yield, again, is, I would call, your best benchmark or barometer to track where mortgage rates are going. And you can see here that we've had a little bit of improvement since last Friday. Last Friday, we were approaching 4.3 plus. We're better than that this week. Right now, as of today, we're down to about 420. And essentially, the market's winding down. Why? Because tomorrow is Good Friday, just before Easter. And as a consequence, in fact, the markets are going to be closing early tomorrow. So we're probably at a point where there's not going to be much changes in the bond market or mortgage rates between now and Monday. So with that, why are we at where we're at in terms of bond yields and mortgage rates? Well, this week, in terms of economic data points, the calendar has been or is light. There's not been a lot of economic data points released this week. In fact, really, the only ones of significance are the ones listed here on the sheet or on the slide. The initial claims for unemployment for this week came out today. It was forecast at 214,000. The actual number ended up being 210,000, same as the previous week. So that's good in the sense that it's stability. You'd like to see if that was increasing, then that might have put a little bit of positive pressure on bond yields. But again, it came out same as last week. So as a result, the bond market really didn't react to this number. The next significant data point doesn't come out till tomorrow. That's the Personal Consumption Expenditures Index, or PCE. Reminder, that's actually the Fed's favorite inflation data point. It excludes food and energy. And you can see here on the screen that the PCE year-over-year forecast is for it to be 2.5%. Previous month, it was 2.4. And then the core PCE, the year-over-year forecast, 2.8. Expected to be unchanged from the previous month. So if these forecasts prove to be the case tomorrow when these actual numbers are released, I think that should be generally positive for the bond market as well as the mortgage market. And of course, keep in mind when these data points tomorrow are released, we've got a shortened day in terms of the markets because of Good Friday. So to the extent either these numbers when released are good news or bad news, we may not see fully the result of those new numbers on the markets until Monday. Probably the most important thing on the calendar for this week is tomorrow, and it's Chairman Powell, Chairman of the Federal Reserve. He will be speaking on monetary policy at a monetary policy conference. So as you know, I've talked about it before, the markets are always on the edge of their seat when Powell speaks. And so he is going to be speaking about the Fed's monetary policy plans going forward. That sometimes can be a market mover, either to the positive or the negative. So we'll have to see how what occurs in that regard. It's going to be at 8:30. It starts at 8:30 a.m. Pacific Standard Time. That's already 11:30 a.m. Eastern Time. And by noontime Eastern Time, the markets are going to be closing. So again, Powell's comments, whether the market's going to be reacting favorably to those or negatively to those, we probably won't see the full brunt of that until Monday. But again, the Fed chairman's comments are certainly going to be are anticipated. And again, the markets are going to be on the edge of their seat to see what happens. The going, expectation is the Fed starting to lower the Fed funds rate still in June is looked at as the first month that may occur. There's some folks thinking, why is that happening? Because the economy seems to be still strong. The stock market's strong. Maybe there is not a need to lower rates yet. So we'll see what Powell says tomorrow. That's going to be very interesting. So there's your mortgage market and bond market update. Rates are hanging in there. Again, if you're on the sidelines, I would encourage you to get off the sidelines, embrace where we're at in terms of rates. We're hoping for a little bit more improvement, but I don't think it's worth your while if you're going to be a home buyer to continue to sit on the sidelines and wait for lower rates. I think that could be a long wait, at least to the extent you're looking for a big drop in interest rates. I don't see that happening anytime soon. So with that, I want to go to another slide where I want to comment a little bit about something that actually comes up quite often when we're originating new loans, in particular purchase loans. And I saw this article online on the financial news page, and I wanted to go over it because the article I thought was kind of interesting, and as I anticipated, was making a suggestion about, when the time you're closing, and in that regard, it was sort of making that claim based on certain assumptions that I think are somewhat faulty. Now, the article I'm referring to is, you can see the headline of the article there. I'm a real estate agent. Don't close escrow at this time of the month. It was in Go Banking Rates on Tuesday, March 26. You can see there the name of the writer. And when I saw that headline, I chuckled to myself because I thought, this suggestion, I think, is probably, like I said, a little bit faulty. The basic premise of the article was that closing at the end of the month is going to save you money. And of course, I put a question mark on that first bullet point, because really, is that really true? Is it going to actually cost you less on a mortgage if you wait and close at the end of the month? Well, let's explore that. The further premise of this is the writer is suggesting that you should close at the end of the month, because if you close earlier, or basically any time in the end of the month or any time during the month, there is going to be a proration done for property taxes, for homeowners insurance, and for prepaid interest when you're getting a mortgage for the transaction. So the overall suggestion is, by closing at the end of the month, the amount of those prorated expenses is going to be less, and therefore you're going to save money. Now, I'm going to challenge that a little bit here in these further bullet points in my comments. First, understand something that's pretty important when it comes to getting a mortgage on a home purchase. When you get that mortgage, your first mortgage payment is going to be due 30 days after the first of the month following the month you close. Let me repeat that. When getting a mortgage on a purchase transaction, the first mortgage payment will be due 30 days after the first of the month following the month that you close. The basic idea is your first mortgage payment, when due, is supposed to cover at least a 30-day period of time. So, for example, we're in March. If we close a loan in March, the first payment date isn't going to be April 1st. It's going to be May 1st. Why? That May 1st payment pays the interest in arrears on the mortgage. So that May 1st payment covers the interest due on the mortgage from April 1 to May 1. So obviously, if you close at the end of the month, you won't have a whole lot of proration done on the mortgage that's closing, because your first mortgage payment, if it's due May 1, covering April 1 to May 1, and let's say you're closing today, March 28th, you're only going to have about 4 days of prepaid interest that isn't accounted for when you make that May 1 payment. Now, and occasionally you can have a situation where you might close the first couple of days of the month, like let's say you close next week on April 2nd or 3rd. You can still have a May 1 payment. When that happens, you actually get a credit of prorated interest, because your May 1 payment is paying for a full 30-day period, April 1 to May 1. But if you don't close until April 5th, then that May 1 mortgage payment is paying too much interest, so they give you a credit for that 5 days at the closing of the transaction. There was a particular sentence in this article that really got my attention, and as I put below the bullet point I'm going to read to you, I declared that it was an untrue and somewhat nonsensical statement. So let me read it to you. If you close on a home on the 5th of the month, more than likely, your first actual mortgage payment would not be due until the first day of the following month. Well, right there, that's not quite accurate. Maybe the writer just made a mistake in editing that sentence or creating that sentence. If you close on a home on the 5th of the month, more than likely your first actual mortgage payment would not be due until the first of the following month. That's not true, as I explained earlier. If you were closing a mortgage on March 5th, your first mortgage payment is not the first of the following month. It's not April 1st. It's still May 1st, which is essentially 56 days away. Now, the rest of this sentence goes on to say, so you have to pay the interest up front for that entire period that you were not even living there yet. Well, I call that nonsensical. And the reason I do is if you're going to close, particularly a purchase transaction on March 5th, and you're going to prepay interest for basically 26 days from March 5th up to April 1, yeah, that's more expensive closing. But remember that your first payment isn't for 56 days after the closing date. So, and the idea that if you close on March 5th, that you're going to be paying all that prepaid interest for 26 days without having the benefit of moving into the home, well, I would argue that almost never happens. Now, it's true, somebody buying a home that they're going to live in, when they close escrow, they may not move into it right away. Maybe they want to do some minor enhancements to the property. Maybe they want to repaint it. Maybe they want to do some other minor work to it to prepare to move into it. So in that respect, yeah, you may not live in it right away, but this article, I think, misses a more fundamental point. When you close early, yeah, you're paying more for these prorated expenses, but you're getting possession of the property at that earlier date, allowing you either, number one, to move into it right away and not have a first mortgage payment for almost 2 months. Or, yeah, maybe you're not going to move into it right away, but you still get possession of the property after March 5th in this example. So if there is some minor enhancements you want to do to the property, you can get access to the property and actually get it done. I would argue in either one of those scenarios that prorated, higher expense for, proration of taxes, insurance, and in particular interest is well worth it. And as I put in the last bullet point, early month closing does mean more prorated expense, but it also means your first payment may be close to 60 days away. So is there a really net cost savings? I would argue no. When you close earlier, yes, more prorated expenses, but you get possession of the home sooner and your first mortgage payment is pushed much farther out, almost 2 months. I would argue, yes, there is a cash flow benefit to your household closing late in the month. But on the other hand, if you close early in the month, getting possession, I think, compensates for or offsets that additional prorated expense so that in reality, you're not really saving any money net. And of course, to conclude with that my analysis, I would say, have you ever heard of 6 of one, half dozen of the other? That's the way I would portray or characterize this concept. I tell my customers all the time, yeah, you can close end of the month, and yeah, you'll have less prepaid expenses, but your first payment's a lot sooner. So keep that in mind, because that first payment coming a lot sooner may actually prove to be a bigger burden for you than just closing early and paying those prorated expenses. So anyway, that's my conclusion on that. Just wanted to share that with you. I think this article is a little bit misdirected and misguided in terms of the advice it's giving. So with that, I want to go into basically the primary focus of our program today, and that is the recent NAR, that's National Association of Realtors settlement. So I want to cover a little bit what it means for both buyers and sellers. I had the opportunity actually yesterday to attend a town hall meeting with the attorney who is the counsel for our local here, Greater Palm Springs Realtors Association. So he conducted a town hall meeting with the association members to go into great detail about the settlement and what it means for buyers and sellers. So I want to get into the details on that a little bit. And as you probably have heard, the whole idea with this settlement is to change how real estate commissions are being paid. And it's really more about how they're going to be paid and negotiated, not so much the focus on how much is going to be paid. That's, as you're going to find here as in my comments, that's really going to kind of squirt out over time as these changes are made. Understand first that the goal of this legal action and the settlement is to provide more price transparency and more competition. And by price transparency, what we're talking about is more transparency as it relates to real estate commissions. And the expectation is by making real estate commissions more transparent to all parties, in particular to buyers, then that may create more competition, which is deemed generally to be healthy and should help maybe over time to reduce the cost to both buyer and seller as it relates to real estate commissions. Now, the rule changes involved are expected to be implemented by mid-July of this year. So they're not implemented yet, but they're expected to by mid-July of this year. So keep that in mind. And in the interim, what's going to be happening is a lot of the real estate forms, the contract forms that are used on real estate transactions, there's going to be some revisions to some of those. There may be some new ones, all related to this settlement. So it's basically that period of time between now and mid-July when that work is already underway. And so that by that implementation date, all the disclosures that would be involved will be updated and more in compliance with these the new rules as a result of the settlement. One of the most important things about this settlement is to basically create a situation where buyers agents will no longer be marketing their services for quote unquote for free. Now, what the heck does that really mean? Is that really what's been going on? Well, keep in mind the historical context of real estate commissions. For the past 60, 70 years, what's been happening is when a real estate agent negotiates a listing with a seller, part of that listing agreement will be a negotiation with the seller by the listing agent to determine what is the commission amount the seller is willing to pay. And, historically, a number of 6% became sort of the golden or the going rate, if you will. That was really not set by any policy decision or rule implementation. That just became sort of a customary number that's continued for literally decades. In more recent years, we've seen that get compressed a little bit. I've seen a lot of transactions where the total commission that the listing agent's negotiating with the seller is 5%. And then what happens in those negotiations in that listing agreement, it will also involve what percentage of that total commission the seller is authorizing the listing agent to offer to buyer's agents. And usually it would be a split 50-50. So if it was a 6% commission negotiated in the listing agreement, 3% would be offered to the buyer's agent, 3% would go to the listing agent. Or if it was 5, then 2.5 and 2.5. So, and then what would happen is if a buyer approached a real estate agent to represent them as a buyer's agent, the general practice has been that agent will start showing them property and ultimately, get them pre-qualified by somebody else, but like us, and submit an offer. And the buyer's agent would be aware of what they're getting paid, not because they entered into a written agreement with the buyer, but because they looked at the listing. In the listing itself, there would be a section that would indicate what commission amount, either dollar amount or percentage amount, is being offered to the buyer's agent by the seller. So that's what's been happening up until now. But the odd outcome was it meant as a real estate agent, you could start working with a buyer, help them look for homes, represent them, submit an offer without having any sort of written agreement with the buyer. And that was identified as really sort of an odd outcome that needed to be addressed. And because, without that gave the buyer agent the ability to give the buyer impression that they were going to be providing their services to the buyer for free because the buyer wasn't paying it. It was going to come out of the seller proceeds. So that's an important point to make. That's no longer going to be part of the landscape, if you will, for real estate commissions going forward. Even more important part of this settlement is going to be the use of buyer broker agreements that are going to be required before touring. Now, buyer broker agreement, actually, that's a disclosure, a form that's been around for a while, but it was rarely used because you didn't have to. That's going to be changing. A buyer broker agreement is now basically going to be recommended, if not just required. In fact, it is going to be required before a buyer's agent can begin touring properties with that buyer. So that's going to push the commission paid to a buyer's agent to the forefront and not to be dealt with by the seller, but more directly dealt with by the buyer's agent representing the buyer. They're going to have to sit down and execute a buyer broker agreement where the buyer's agent's going to have to negotiate with the buyer what they want to get paid for their services. And that's part of the transparency issue, to get that in the forefront in the buyer's mind, to let them know that if they're going to retain a particular agent as their representative in searching for a home and negotiating a purchase, they're going to now be aware of what that buyer's agent is expecting to get paid, and that potentially it's going to have to be paid by the buyer, not necessarily by the seller. And so, again, as I've covered in the previous bullet point, this will now eliminate an agent representing a buyer without a written agreement. So that is considered a good thing. And in that respect, the compensation identified, and this is true both with the listing agent negotiating their commission with the seller in the listing agreement, but the buyer's agent negotiating their commission with the buyer in the buyer broker agreement, the compensation amount must be specific. It can't be verbiage such as, a dollar amount or a percentage amount up to, or an approximate amount. It has to be specific. And what's interesting about this new rule is it's also been established that the buyer doesn't have to hire a real estate broker to help them find a home. They can choose someone else. I've read one article that suggested, well, you don't have to get an agent. If you're a buyer and you want help in finding a home and negotiating a purchase, you don't have to get a real estate agent. You can use somebody else, like an attorney. And in that article, it talked about how, well, yeah, now you can, get an attorney to represent you instead of a real estate agent, so that instead of the real estate agent making $50,000 on a commission on a particular, price level, now you can have an attorney represent you for $1,500. Well, I'm not aware of many attorneys who would probably be willing to negotiate a real estate transaction and represent a buyer for just $1,500. So I think that's a little bit exaggerated. But the overall point is the expectation that, maybe don't hire an agent as a buyer's representative, hire an appraiser. Or heck, you could hire somebody like me to represent you to purchase a home. And again, you'd have to do that by executing a buyer broker agreement with the individual you're asking to be representing you, and then also negotiate the specific commission that you're going to be potentially having to cover. One of the other issues related to this settlement and why it's happened is to avoid or eliminate a practice that was actually pretty common. And that is, up until this settlement, it's been the case, as I alluded to earlier, when you look at a listing or an agent looked at a listing when they're representing a buyer, that listing would have a field on it that would indicate the amount of compensation, and it's usually in a dollar amount or a percentage amount, that the listing agent, or actually the seller, is going to offer to the buyer's agent. And that portion, or that field in the MLS listing agreements, or I'm sorry, the MLS listings themselves, it's going to be eliminated. Now, why would that be? The idea, again, is when this rule settlement is fully implemented, the MLS listing is no longer going to have a field indicating what the seller is willing to offer to the buyer's agent on a commission. It's going to be gone. Why was this done? Well, it turned out it was done, or being done, for a very good reason that's really just not been focused on for quite a long time. And that is, real estate agents, if they saw listings where the amount offered to a buyer's agent was considered too low, like 2% or 1.5% or 1%, there was determined that there was a practice where real estate agents would simply eliminate or exclude those listings for their search of homes that they want to show to their prospective buyer. The idea being that a real estate agent, a buyer's agent, would decide not to show certain property to a buyer simply because the commission amount being offered by the listing side, by the seller, was deemed too low. So they would just not show them the property. That was considered an abuse of the existing system. And part of this settlement, in fact, a big part of this settlement, was focused on eliminating that ability to exclude listings simply because you, as a buyer's agent, you didn't think the seller was offering you enough commission for your services to your buyer. So that's an important item that's now being eliminated from an MLS listing. Now, what's going to happen in replace of that? The talk is there's going to be a concession field added to it, to the MLS listing. Now, the concession field is not the same as a buyer's agent compensation field. Instead, the concession field is going to be a field where the listing agent and their seller, if they so choose, can decide to input in this field that they're willing to consider, and key is willing to consider, a concession in either a dollar amount or a percentage. Now, the idea here is this would replace the previous compensation offer field with this new concession field, the idea being it would be a way for a seller and their listing agent to signal to prospective buyers and their buyers agents how much the seller may be willing to provide in a concession to cover what the buyer may have to pay to their buyer's agent per their broker buyer agreement. So let's say if I'm a buyer's agent and I've negotiated or executed a buyer broker agreement with my prospective buyer, and I've got my buyer to agree to pay 2.5% commission for my services as a buyer's agent, well, this concession field will be a signal to buyers agents and their buyers that certain sellers may be willing to consider providing a concession to offset all or maybe a portion of that buyer agent commission that's reflected in the buyer's broker agreement. So that's the change that's going to be made. Again, the whole idea here is to make the commissions more transparent and to get a written agreement in place with the buyer and their agent, in addition to the written agreement that's already done most often or all the time between a listing agent and the seller versus their, with their listing agreement. Now, there's a couple of areas where these changes could have some pretty important implications and effect. One is lender concession limits. We've talked in this program before. There are concession limits that all the mortgage agencies have for different loan programs, for conventional conforming loans, Fannie Freddie loans. The concession limit from an interested party, and that, of course, most often is the seller, is limited based on your down payment size. If you're putting less than 10% down, it's only 3%. If you're putting 10% down up to 25%, it's 6%. And then 25% or down, 25% down or more, it's 9%. FHA, it is 6%. VA, it's only 4%. Well, here's the potential problem, especially if we're going to have this concession field added on an MLS listing. If the concession being offered by the seller is going to cover the buyer agent commission per the buyer broker agreement, will that concession type be considered part of the interested party concession or contributions that would be subject to the limits? That could be a problematic situation, particularly if you're a first-time home buyer, you're putting less than 10% down. Let's say you're putting 3% down. Well, and let's say your buyer's agent that's representing you wants a 2.5% commission. And even if the seller is willing in their concession field, willing to consider offer of 2.5%, if that is deemed to be a seller concession as part of the interested party contribution limits, well, the problem with that is it eliminates the ability, it uses up in the case of a conventional buyer with 3% down, 2.5 of the 3% concession limit is used up by the commission. So if that buyer is having trouble for their cash to close and would like a seller concession to help cover some of their closing costs, well, that concession limit of 3% is going to be undermined if that 2.5% commission that the buyer agent wants and that the seller agent is willing to, or seller is willing to provide as a concession, it'll use up most of that. And so there's no money left to help the buyer with their other closing costs. So this could really drastically affect how much more cash a buyer in a minimum down payment situation will have to come up with potentially to complete a transaction. Now, my early sense is, and I'm already seeing evidence of, I think what's going to happen with FHA, with VA, with Fannie Freddie, I'm predicting that any commissions that end up being paid by a seller as part of the negotiation in this new format will be excluded from the interested party contribution limits, thereby not diminishing those limits when they're going to be used by a buyer either to help cover their closing costs, pay for a rate buy down or a temporary rate buy down, and so forth. So I think that's going to be the most likely outcome is to exclude seller concessions that are applied specifically to buyer's agent commissions per the buyer broker agreement. I am predicting that those amounts will be excluded from the interested party contribution limits in order to maintain a sort of a level playing field and a more fair situation for home buyers who are getting financing, particularly with a minimum down payment. Then the one other issue that I want to touch on that's going to be a little bit problematic is dual agency. If you think about it, a buyer may decide, well, gee whiz, I don't want to hire a real estate agent to represent me as a buyer's agent, especially if I have to sign an agreement where I'm going to have to agree to pay 2.5%, 3% to that buyer's agent without knowing for sure the seller might be willing to give me a concession to offset that. So I'll just bypass getting a buyer, an agent for me as a buyer, a buyer's agent, and I'll just go straight to the listing agent and try to negotiate my purchase with the listing agent. And that way I don't have to, commit to a commission amount that I, as the buyer, might have to pay. Well, that's problematic, particularly in California. California Association of Realtors is already on record. They frown upon dual agency situations. It's not specifically outlawed or prohibited yet, but this new landscape, this new environment, and these rule changes could create some, incentive for buyers to just bypass using a buyer's agent at all and go directly to the listing agent. So we're going to have to see how that plays out, because again, it's going to create, potentially an outcome that is already frowned upon. It's really not, something that's considered a good thing to do, a dual agency situation, because an agent in that situation has got a little bit of a dilemma in terms of who are they really representing. It's hard. You can't really represent and have a fiduciary duty to the seller while at the same time representing the buyer. That, again, is problematic. So that is one area of these new rule changes that I think is going to be subject to more focus, and potentially some new changes, those of which we do not know yet. So just be aware, those are the two areas I think that are going to be most problematic with this new environment, with this settlement and the new rule changes. I think overall, eventually, it's going to work itself out. It's just simply going to mean, again, commissions are going to be more transparent, are going to be more specifically negotiated upfront by both the seller and their agent, the buyer and their agent, if they have their own agent. And I think ultimately that's going to be a good thing. So that's where we're at on the settlement, the kind of things that we're going to see coming. So hopefully that'll help you be more informed if you're looking to get into the real estate market now to buy a home. Just be aware of these changes. I think ultimately this is not the end of the world, and I think we're ultimately going to be okay. And this will, work itself out, and we'll still have a pretty good, efficient market. Will there be some improvement or diminishing of real estate commissions? Possibly. And to that extent, certainly it'll help both buyers and sellers. So we'll just have to see to what extent that actually happens. So there you have it. Those are my comments on the settlement agreement for buyers and sellers, what it means. So if you have any, follow-up questions or need more information on that, feel free to get in touch with me, and I'll be happy to discuss any specific scenarios that you have in mind. With that, I'm going to go ahead and go on to our next slide, which is actually the closing question from last week, which actually was 2 weeks ago, since I was out last week. So here it is, and just to remind you, I have a friend who recently applied for a mortgage and told me that during the process, the lender asked her to explain a few addresses from many years ago. What does this have to do with getting a mortgage to buy a home now? This is a very common question. I get this a lot. And so it's a very good question to touch on. And the thing to understand when you're in the loan process, and this is true whether it's a purchase transaction or a refi, understand that if you start getting requests for explaining past addresses, the reason for it is it's all about fraud monitoring. The mortgage business is an area that has probably more fraud than just any other industry. So the whole reason for this is the need to identify potential fraud risk and errors in mortgage applications. So we start with address variations in the loan file. When all the documentation's collected, if we see different home addresses on, a driver's license versus a bank statement versus a tax return, that inconsistency raises the red flag of potential fraud issues. And so the lender is going to focus in a diligent way on why are these variations and want to make sure that the correct addresses are reflected on these documents. Another area where this comes up quite a lot is on your credit report. When we get your credit report, it includes a section with address history. And for example, we'll get an application that the current address on the application where they live says they've been there for 10 years. But we might, when we get the credit report, it'll show another address that was reported at one of the credit bureaus a year ago. And presumably that was represented a year ago on a credit application that reported to the bureaus as their primary address. Well, on the application, they say they've been living at their current address for 10 years, but they applied for credit and it was reported to one of the bureaus with an address different in the last year. We need to get clarification on that. Does that mean they own both addresses? And does that therefore mean they own another property they didn't disclose? And then this process is even more fully focused on through lenders use a third-party vendor. The most common one is Fraud Guard, and they provide lenders what they call loan quality assurance tools. This Fraud Guard tool is used for an extensive search on the background of the borrower, nationwide ownership and occupancy search, lien and judgment reviews, bankruptcy search, as well as associated business search. So the idea here is the Fraud Guard third-party loan quality tool is used by lenders, again, to try to identify inconsistencies, particularly with property addresses, to make sure you're not guilty of non-disclosure of other properties you own, non-disclosure of liens or judgments or bankruptcies, or non-disclosure of other businesses that you're an owner of. So the Fraud Guard process is extensive search of the borrower's background for all of these items to ensure that the application is fully accurate and that nothing that is relevant to the underwriting decision has not been disclosed. So that's the reason you get asked for these explanations for where you lived 20 years ago. There is a logical and justified reason for that. It is tedious. I know it's a pain for a lot of borrowers. We try to help you with those explanations. I can usually ask a borrower, just let me know the details, and then I can write up the explanation for you and then send it to them for signature. So that's the reason for that deep dive into the borrower's background. It's valid. There is a good reason. And in most cases, it doesn't cause a problem. We just need to cross the T's and dot the I's. And with that, I'm going to go to the closing question for next week. And this is a good one. We run into this every so often. I just ran into this about a month ago. When buying a home, how are the escrow and title companies chosen? And can a buyer shop around for those services to get a better deal on their fees? Well, I certainly have some thoughts on this. So stay tuned next week where I'll have the answer to this question and it'll be on the house. Jeff, back to you.
Boy, what a show, Art. A lot of good information in there. I mean, all I could think about was you were talking about the NAR meeting and the idea of like, wow, how uncomfortable is that going to be before you can say, well, yeah, I'd love to take you out to show you some properties, but I need you to sign this agreement that says I'm going to make 20 grand to do that when we find a house for you.
Well, you're right. I mean, for some agents, that's going to be a pretty uncomfortable interaction with their prospective buyer. But at the same time, I'll tell you, there's some agents out there, mostly the more successful and experienced ones. A lot of them are already starting to do that. And to that extent, I think that's a healthy thing for a real estate agent representing buyers, a process that I think it's healthy for them to go through. And that's, again, part of the intent of this settlement and the new rules is buyer agents can no longer start working with a buyer without a written agreement, written representation document, including what they're going to get paid. After all, on the mortgage side, we've had to disclose what we get paid for a long time. I mean, that's been a very specific focus, not so much with real estate agents. So in some respects, as a mortgage, person, I kind of like the idea that they're going to now be more directly under the same kind of scrutiny we are in terms of their compensation, just as we are with ours. So I think ultimately that's going to be a good thing.
Well, it reminds me of, and it kind of, I don't want to let the cat out of the bag from the next week's closing question, but it would kind of remind me of if I'm going to go shopping for somebody and somebody says, this is my rate when it comes to the loan origination fees, like you have a 1% loan origination fee. I'm like, I'm going to go with Art because he's going to give me the same service, but it's going to cost me less.
Right.
I'm just wondering also, this rock has now been dropped into the pond. what other industries now could this set precedence for? Like when I walk on a car lot, before that person can talk to me, do I have to sign an agreement that I'm going to pay him? And do they have to disclose how much profit is in every car before I can even negotiate it? So I know for sure he's showing me a car that's best for me, not the highest profit margin.
Yeah, that could be. Although my initial reaction to that is, if you think about buying a car, I mean, typically the salesperson that you meet on the lot, um, they're employed by the car dealership, and so in that respect, they're an employee of the car dealership. In that respect, as an employee, they're really representing the car dealership. They're not really representing you as the buyer per se. I mean, you don't have the same kind of disclosures and so forth that you have with a real estate transaction. So we'll see what happens there. Yeah, could it have some effect on escrow and title fees? Maybe, but again, we'll get into that next week with that closing question. So.
Yeah, and I'm just curious. You said, as I think one of your bullet points, has said, "Hey, maybe I don't even have to have a real estate agent or a real estate broker to represent me. I'll just go in there in this dual agency." When that happens, Art, maybe just a little clarification. Let's say, for instance, you're representing the seller, and I just come to you, and you've agreed to pay 2.5% to the buyer's agent, but I don't have a buyer's agent. Does that mean 2.5% less as far as the cost, because that money's not going to anybody? We're not using it.
Well, in some respects, in fact, that already happens now. I mean, in most cases, what you see with a real estate agent who's going to, get a new listing, and they're going to execute a listing agreement. And the listing agreement, at least currently, as I explained on that slide, it's going to reflect a total commission amount that the seller is willing to pay. And again, historically, it's been 6%. It's been compressed to more often be 5%, but it's going to be somewhere in that range. And then that listing agreement will dictate how much of that is going to be offered to the buyer's agent. But usually that agreement will further address what if there is no buyer's agent and that listing agent ends up double ending it. Well, that listing agreement would usually address that by saying, okay, if there's no buyer agent and you, my listing agent, are going to represent both sides, then I'm not going to still pay 6%. Now I want to agree to only pay 4% because I don't want to give you, my listing agent, the whole 6% if it turns out we don't have a buyer's agent that we need to offer anything to at all. So in that respect, you're representing both sides. I don't want you as my listing agent to receive a windfall. Therefore, in that scenario, I'm not going to pay 6%. I'll pay 4 or maybe 3.5. So that's already done on a pretty routine basis in listing agreements. And that could still happen going forward. So
my final thought on that, and I think that clarifies that very, very well, is like, okay, it doesn't, if we said 6% total, it doesn't all of a sudden stay at 6%. It can be renegotiated down so that it's, like you said, it's 4%, because if they're doing both sides of the transaction, there is more work involved, obviously, but there's not this buyer's agent per se, and it could be negotiated down.
right.
The other piece I was curious about is what's your gut feeling, your prediction on the Ouija board of what's going to happen to buyers agents? Will we see that particular agent start to change and just become a listing agent for sellers?
Well, for one, I will tell you that in a lot of cases, when it comes to agents, many of them, in fact, in particular, a lot of the good ones, tend to be more listing agents anyway. And there's agents out there who just will, if they're being honest, they'll admit, I don't really like to work with buyers. They're too flaky and I can't trust them. And, I put all this work in, and then they may end up, going into an open house and talking to a listing agent who's on site and decide to pursue that house and ace me out of the deal. So that in the current environment, that could happen from time to time. So some agents don't like to work with buyers because of that. I think actually, though, what will happen with these rule changes is I think there'll be a little bit of a flushing out of agents working with buyers, but I think the ones who are going to survive are going to be the better ones. And they're going to be the ones who I think are going to be more willing and more comfortable negotiating their commission in the buyer broker agreement. Plus the fact that in the long run, that's going to be more beneficial to that buyer's agent because now they have a written agreement that does stipulate they're going to get paid and how much, so they're more protected in case that buyer does suddenly try to abandon them and go to another agent, like I said, maybe through an open house, and try to bypass that buyer's agent altogether. So ultimately, I think it's going to be to their advantage. Will there be sort of a fleshing out on the number of agents who want to be buyer agents? Probably so, but it's going to be the part-timers, the inexperienced ones who are most likely going to exit the industry. The good ones who know what they're doing. I think this actually could help them improve their income even going forward.
That's great. Well, I think the other part of this is you said, and I want clarification on this. This was a settlement. So are these rules and guidelines now in stone, or are they one of those things that said, hey, as we move through this, we realize this is the kind of adjustment that needs to happen to make sure it works properly? Is there any gray area on this that you're aware of?
Well, possibly. I mean, are the new rules in stone? I mean, certainly the essential basic parameters of these new rules are, but the reason the implementation date is off into July is because we have this interim period where there is a need, particularly on the lending side. Some focus has to be done in terms of what are the sort of the unintended consequences of this. And like I said earlier in that piece, the biggest area of concern is these concessions. If sellers start providing concessions to buyers in their offers to be willing to pay a buyer's agent commission, and if that's identified or described as a concession, we've got to make some changes in how the industry looks at the term concession and delineate between interested party contributions associated with paying closing costs or paying the cost of a buy down versus a seller simply paying the buyer's agent commission. I think that's in the works now and should be more clarified and more set in stone by the time we hit July. And then probably something along those lines too for dual agency.
Well, I tell you what, Art, you have really shed some light on this. And I think anyone, whether you're a buyer or a seller or a real estate agent, this is a great piece so they can go back and say, hey, let me find out exactly what's going on. I think you were very unbiased to share the information and then share some ideas of, how is this going to shake out and maybe what to do. So I really appreciate you spending some time on this. I know we went a little longer than we normally do, but I think this is a really important topic that is industry changing, that we haven't seen these kind of rule shifts in, like you said, 50 or 60 years since they started doing things, with commissions way back when.
Well, that's true. And that's, to me, ultimately, I think this will all play out okay. But when you've been doing something a certain way for that period of time, I mean, decades, 60, 70 years, any kind of change initially is going to be uncomfortable. So it will take all of us some time to work through the details, tweak some things that, like I said, unintended consequences that need to be addressed. That process will play itself out. I think ultimately this will be a good thing for all parties involved. So
sounds great. Hey, information for Art, if you want to get a hold of him, he does all kinds of loans. And I mentioned earlier, he is the home of the 1% brokerage fee, meaning that, the fee that he gets paid is paid by the lender and it's 1%. That's not common in the industry. This means it saves you money, but it actually doesn't cost you any of his expertise. He has over 4 decades of expertise in the lending industry. His information, 760-883-5700. That's his office number. You can always call him on his cell phone, 714-612-9035, because he operates out of here and also Orange County. So he takes care of Southern California. And actually, he can originate loans in anywhere in California. And the website is mwloan.com. It's a good place to go to say, hey, what are the rates doing right now? The 3-2-1 buy down. If you're thinking, I want a 3.5% loan, is it possible? Call Art, because a 3-2-1 buy down is in your future. And of course, you can always get a hold of Art at mwloan.com. Art, thank you so much for sharing this information today. And again, 760-883-5700. Call Art today and get pre-qualified. Oh, I want to ask one thing. The doors open for the California Home Dream Buyer Program. When?
Next week, April 3rd. So we have a period from April 3rd to April 29 where we can pre-qualify prospective buyers for the California Dream for All program, get their pre-qualification letter into the California Housing Finance Agency so they have the ability to participate in the lottery, which will be done at the conclusion of that period on April 29th. And then hopefully you'll get a voucher that you can then use to go find the home and get your funds allocated.
Yeah, you want to go ahead and reach out to Art. Again, his number's on the bottom there about that Dream for All program, California. That's up to 150, or is it $150,000 in your down payment, or 20%, whichever is the least. But hey, this is one of those things. Even if you get the smallest part of the pie, you are still a big winner. Call Art today at 760-883-5700. Art, have a great weekend. And again, happy Easter. Be safe.
Yep. Thank you, Jeff. Thank you, everyone. Thank you for watching and listening to this week's Mortgage Minute. As Jeff said, if you do celebrate Easter, happy Easter this coming Sunday, and enjoy your sort of half day off tomorrow on Friday, Good Friday. So in the meantime, we'll see you again next week for another edition of the Mortgage Minute. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. So long. Take care.